While most of the market is fixated on Bitcoin's daily price chart, they're watching the wrong signal. Because the real story, the one developing just beneath the surface, isn't about day-to-day price action. It's about supply. And that supply is quietly disappearing from the open market. Here's the situation. Massive institutions are now buying up nearly every Bitcoin that becomes available. And yet, the price seems stuck. After a powerful run to nearly $126,000 in late 2025, the market pulled back, and for weeks it has been hovering in a tight range. It looks flat, indecisive, and for many, it's frustrating. This is where investors get positioned wrong, right before the biggest moves of the cycle. Because have you stopped to ask the critical question? What happens when the sellers finally run out? What happens when trillion-dollar asset managers show up to place their daily buy orders, and there's simply nothing left to buy at these prices? The outcome isn't a slow grind higher or a clean, predictable breakout. It's a gap, a sudden and violent repricing that happens before most people even realize what's going on. In this video, I'm going to show you the data that proves this is already happening beneath the surface of this deceptively calm market. I'll explain why this sideways price action isn't a sign of weakness. It's the hallmark of a setup. And why when this finally breaks, it won't feel gradual. It will feel instant. Let's be honest, this market feels confusing. For many, it doesn't seem to make sense. We just witnessed one of the biggest structural changes in Bitcoin's history, the approval of spot Bitcoin ETFs. This wasn't just another news headline. It was the opening of a permanent bridge between the deepest pools of Wall Street capital and Bitcoin's mathematically fixed supply. BlackRock, Fidelity, the largest asset managers in the world are now all competing to accumulate Bitcoin on behalf of their clients. Logically, that should have sent the price vertical. Instead, we got this: a market stuck in a narrow, sideways range with low volatility and muted trading volume. And this is where the frustration sets in for most investors. You see billions of dollars in ETF inflows, you see massive institutional demand, and you see public companies continuing to buy aggressively. And yet, the price goes nowhere. So what is really going on? Why isn't Bitcoin already well on its way past its old highs? This is where the story flips, and it's the part most people miss. Bitcoin's price is not the signal, it's the result. It is the very last thing to move. The real shift, the one that matters, is happening at the level of supply. And once you understand what's happening to the available supply, this entire market starts to make perfect sense. Think of the market as a system in balance. On one side, you have demand from institutions, ETFs, and retail investors. On the other, you have the available supply from people willing to sell their Bitcoin. For the price to move significantly, one side has to overwhelm the other. Right now, they appear to be in equilibrium. But that balance is a temporary illusion. And this is where it starts to get important. What we're witnessing is a classic financial phenomenon known as seller absorption. Here's the simplest way to visualize it. Imagine a giant industrial sponge. That sponge represents the relentless, programmatic demand from institutions and ETFs. Now, imagine water being steadily poured onto it. That water is the supply of Bitcoin being sold on the market. As long as the sponge has the capacity to keep absorbing, the water level doesn't rise. From the outside, nothing looks dramatic. The price appears stable, flat, maybe even boring. But underneath the surface, a massive transfer is taking place as huge amounts of supply are being absorbed and taken off the market. That is precisely what is happening right now. For every $1 billion of institutional buying, there has been, up to this point, a corresponding $1 billion of selling. That's why the price hasn't skyrocketed. Not because demand is weak, but because it's being perfectly matched by the available supply. But here's the critical point that changes the entire equation. That supply is not infinite, and the data shows it's starting to run out. So, who has been selling? Where is all this supply actually coming from? It's primarily from four main groups, and the key takeaway is that all of them are finite and diminishing. First, you have the short-term holders. These are recent buyers who often get shaken out during choppy, sideways markets. They tend to sell out of frustration or fear, but their supply is shallow, and they exhaust their holdings relatively quickly. Second are the long-term holders. These are the experienced investors who have held through previous cycles. Yes, they have been taking profits after the recent run-up, and that created a significant wave of supply. However, on-chain data shows this profit-taking behavior is already slowing down as we reach price levels they are happy to hold at. Third, we have the miners. Miners are natural, forced sellers because they have real-world operational costs to cover. But two things have fundamentally changed. The halving just cut their new issuance in half, and their selling post-halving is stabilizing. This means their contribution to the sell side is structurally decreasing. And fourth, the GBTC outflows. This was the single largest, most concentrated source of selling pressure in the market's history. A one-time structural event as the fund converted to an ETF. What began as billions of dollars in outflows has now slowed to a manageable trickle. And this is the moment in the story that should make you pay close attention. For the first time in this cycle, every single major source of selling pressure we just discussed is shrinking. At the same time, that doesn't create stability, it creates a setup. Meanwhile, the institutional demand from the ETFs is constant and programmed to continue. That isn't changing. So, what happens when consistent demand meets dwindling supply? Now let's look at the data, because this isn't a theory, it's a measurable reality. First, exchange balances. The amount of Bitcoin held on exchanges, which represents the available inventory for sale, is at multi-year lows. This inventory is continuously being moved into private wallets for long-term storage. Second, ETF demand versus new supply. On an average day, miners now create around 450 new BTC. Yet, daily demand from institutions and ETFs can be 5 to 6 times higher than that. And if that imbalance sounds extreme, it is, because that gap has to be filled from somewhere. Third, illiquid supply. Data shows that over 72% of all Bitcoin is now held in wallets that show little to no history of selling. This is considered illiquid supply, meaning the vast majority of Bitcoin is already locked away by high conviction holders who are not selling at these prices. Finally, whale accumulation. On-chain data shows that large wallets, or whales, are using this period of flat price to aggressively increase their holdings. They are consistently buying the dips and absorbing any weakness in the market, viewing this period as an opportunity. So if all the data shows that supply is vanishing, why hasn't the price already moved? Because the market is still in the final stages of the absorption phase. But that phase has a definitive endpoint. It's the moment when the sellers are finally exhausted, and that's when the entire dynamic of the market changes in an instant. Here's the key concept to understand. Bitcoin doesn't always rise gradually. It reprices. When sell-side liquidity disappears, the price doesn't slowly climb, it jumps. Think of the market's order book like a ladder. Each rung on the ladder is a price level where someone has placed an order to sell. Right now, as buyers move up, there are still rungs on that ladder. There are still sellers available. But those rungs are getting thinner and spaced further apart. Eventually, a large buyer comes into the market, ready to fill their daily order, and they look for the next rung on the ladder. But it's not there. There are no more meaningful sellers at that price, or the next, or the next. So the price has to instantly move up, not by hundreds, but by thousands of dollars, to find the next available seller. That is the gap. That is the repricing moment. And when it happens, you don't get time to react. It's over before most people even process it. So what does this actually mean for you and your strategy? It means that in a market like this, the obvious risk of price downside is not the one that should concern you most. The far greater risk is being underpositioned. It is the risk of being left on the sidelines, waiting for a perfect entry signal that never arrives because the move happens too quickly. It's the risk of being too late. Because when this absorption phase ends and the repricing begins, it will not wait for you. The market does not care if you are ready. So let's bring this all together. Bitcoin isn't stuck. It is actively and aggressively absorbing all available supply in a tight price range. The institutional demand is relentless and structural, while every major source of sell pressure is shrinking at the same time. The market is rapidly approaching a breaking point, where the sellers simply disappear. When that happens, price doesn't negotiate, it reprices, violently and upward. The data isn't just suggesting this might happen, it's showing you the setup is already in place. The question isn't if this happens, it's whether you recognize what's happening before the market forces you to. So I'll ask you the question. At what price level do you believe the final breakout begins? Where does the real repricing start? Drop your number in the comments below, because in the next video, we're going to break down the specific on-chain signals that could act as a final trigger, the leading indicators that will show us the supply is gone before the price gaps higher. Subscribing isn't just about the next video. It's about seeing the final piece of this setup fall into place. That's where this story gets critical.